It's jobs report day in the US, and as always, there's a lot of hype about these releases. But for once, it wasn't the headline NFP number that really attracted all of the attention. As we can see from the data collection here, there's a lot to absorb from the jobs report. The NFP is usually the headline figure. It's usually the one that writes the headlines. But broadly speaking, this is a number that was just in line with expectations, maybe slightly higher. But the revision is probably more significant because the revision was around negative 30,000 for July, more than offsetting the 17,000 beat that we saw this month, making the NFP number overall a positive as far as central banks and markets are concerned, pointing to ongoing weakness. The rest of the report, though, is arguably more important, though. We look at average hourly earnings on an annual basis, 4.3%, down from 4.4% and below market expectations. On a monthly basis, 0.2%, down from 0.4% as well. But over a number of months now, we are seeing much more sustainable monthly readings in line with what you would consider to be wage growth that could achieve 2% inflation targets like the Federal Reserve has. The other parts of the report aren't too bad either. You look at the unemployment rate ticking higher from 3.5 to 3.8%. That's going to create some warmth from the Federal Reserve, who wants to see less tightness in the labour market. They don't want to see a complete rollover. They don't want to see the economy collapse. They want to see some heat come out the labour market, some heat come out the economy so that they can achieve their goals, which is very difficult at the current pace. That was probably helped by an increase in participation from 62.6% to 62.8%. as well. So across the board here, this is all some very friendly readings. And as I say, the headline NFP number, probably the least influential of the bunch. The question now is, how has this impacted the markets? Now, the first thing we need to say is that the initial reaction in the markets can often play out differently over the next couple of hours, but the initial reaction has been very positive, at least from a Fed perspective. The dollar has weakened. We've seen Treasury yields, both at the short end and the long end, declining slightly. That would suggest that we are seeing more favorable expectations as far as interest rates on the back of this. At this point in time, Fed interest rate expectations are relatively unchanged in the short term, but the expectation for the first rate cut has been brought forward at this point from July to June. On Monday, when we saw at the start of the week, when we saw the JOLTS data released, it was brought forward from August to July. So over the course of 1 week, we've seen a lot of really good jobs data, which has brought forward expectations for that first rate cut from the later part of the summer to the early part of the summer. So this is all really positive, I think, from an economic standpoint in the medium to long term, and from a central bank standpoint as well. And you can see that clearly reflected in gold. Now, gold was struggling around 1950 going into this report. We'd seen a couple of days where the yellow metal was pushing that 1950 barrier, and you can understand why from a technical perspective. We'd seen it rotate higher off the 200-233 day simple moving average band. But around 1950, we had the 61.8 fib. That's from the July highs to the August lows. We also had the 55.89 day simple moving average band, the top part of that coinciding with the 61.8 fib, but also that descending trend line as well, going from the peak back in May. So you had a culmination of technical resistance points here that gold was struggling to break through. Now, we haven't seen a significant breakthrough at this point. We have seen it trade above that level. So it'll be interesting to see how we see the final hours of the week play out. If we can see a close above this level, that could potentially be quite a bullish indicator for gold. But at this time, the fact that we are testing it and testing it with some backed by some really encouraging data and some movements elsewhere in the market, like the dollar and yields, could be seen as very encouraging for gold bulls. But ultimately, as I say, the trading action that we can often see in the aftermath of these big releases can be very volatile. You can't always trust the initial moves, but the fact that we've seen a really positive and promising employment report here from the US will give the Fed officials and gold bulls plenty of promise. But ultimately, it'll be really interesting to see how this ends the week. If we can end the week above 1950, giving us a nice candle close above that 1950 level, it could potentially be a nice bullish indicator for gold.